Ladies and gentlemen, let me start with a question that grabs your attention. What happens when the system everyone trusts begins to tremble? What happens when banks, symbols of stability and power, face the possibility of a $390 billion loss? Today, we are not just talking about silver reaching $100 an ounce. We are talking about fear, opportunity, and the moment when ordinary people wake up to extraordinary change. This is not a story of panic alone. This is a story of awakening. The possibility that banks could face losses of up to $390 billion if silver reaches $100 per ounce is not just a dramatic headline. It is a serious warning signal embedded within the structure of modern finance. At the heart of this risk lies the heavy exposure many large financial institutions have to silver through leveraged positions, derivatives, and paper-based contracts that assume prices will remain stable or suppressed. When markets behave as expected, these positions appear controlled and profitable. But when prices move sharply, the same positions can rapidly transform into massive liabilities. This is why even the possibility of silver hitting $100 is enough to trigger concern behind closed doors. What makes this situation especially striking is the scale. A $390 billion loss would not be absorbed quietly. It would test balance sheets, strain liquidity, and force rapid reassessments of risk models that have been relied upon for years. Banks operate on confidence, and confidence is fragile. When a single asset class threatens losses of this magnitude, it challenges the assumption that the system is fully under control. The hook here is simple but powerful. Institutions designed to manage risk may be standing on it. Much of this vulnerability stems from the dominance of paper silver over physical supply. Banks have issued far more claims on silver than the actual metal available, creating a structure that works only as long as prices stay low and demand for delivery remains limited. If prices rise sharply, the gap between promises and reality becomes impossible to ignore. At that point, losses are no longer theoretical. They become immediate and measurable. Markets do not forgive imbalance. They expose it. This potential loss also highlights a deeper issue: concentration of risk. When a relatively small movement in one commodity can create hundreds of billions of dollars in exposure, it raises questions about how risk is distributed and monitored across the financial system. It reminds investors and policymakers alike that stability often depends on assumptions that may not hold forever. The real hook is not the number itself, but what it represents: a system stretched thin by leverage and confidence. In moments like this, financial markets reveal their true nature. They reward preparation and punish complacency. The discussion around a $390 billion risk is not about predicting disaster, but about recognizing fragility before it becomes crisis. Silver, in this context, is not the problem. It is the messenger. But rising tension in the precious metals market is no longer subtle, and the growing volatility surrounding silver prices is becoming impossible for financial institutions to ignore. Price swings are widening, trading volumes are increasing, and investor behavior is shifting in ways that suggest uncertainty is replacing confidence. Volatility, after all, is not just movement. It is emotion made visible on a price chart. When markets begin to swing without warning, it sends a clear message: something beneath the surface is changing. What makes the current environment especially compelling is that this tension is building while traditional indicators of stability still appear intact. Interest rates, policy statements, and official reassurances may suggest control. Yet, the silver market tells a different story. Precious metals often react before broader markets do, functioning as early warning systems for financial stress. The hook is unmistakable. When silver becomes restless, it is rarely acting alone. Banks understand this history, which is why heightened volatility triggers internal risk reviews and defensive positioning. For financial institutions, volatility is not just a trading challenge, it is a balance sheet threat. Sudden price movements can force margin calls, amplify losses on leveraged positions, and expose weaknesses in hedging strategies. Models built on historical calm struggle to perform under rapid change. As price ranges expand, so does uncertainty, and uncertainty is costly. This is the moment when risk management moves from theory to survival. Investors, sensing this shift, are responding in ways that further intensify market tension. Increased demand for physical silver, reduced trust in paper contracts, and a growing desire for tangible assets are all contributing to sharper price reactions. Each surge in demand tightens supply, and each tightening magnifies volatility. It becomes a self-reinforcing cycle, one that feeds on doubt and anticipation. The hook here is psychological as much as financial. Markets move fastest when belief changes. The broader implication is that volatility in silver is not an isolated phenomenon, but a reflection of unease across the financial system. Debt levels, inflation concerns, and geopolitical uncertainty all funnel into markets that are sensitive to trust. When investors start seeking safety outside traditional financial instruments, financial markets are built on perception as much as performance. Stocks, bonds, and currencies rely heavily on belief in future stability and institutional control. When silver rises sharply, it suggests that a growing segment of investors is questioning those beliefs. This does not imply immediate collapse, but it does indicate stress. Confidence, once shaken, rarely returns quickly. The movement of silver thus becomes a barometer for trust itself. Banks and policymakers watch this signal closely because it challenges the narrative of stability. A strong silver market implies skepticism toward inflation management, debt sustainability, and monetary discipline. It raises uncomfortable questions about whether current systems are rewarding real value or merely circulating risk. The hook is unavoidable. Silver does not argue with policy, it responds to it. As more capital flows toward tangible assets, the message grows louder. A rising silver price is not just a reflection of demand, it is a response to doubt. In that response lies a clear signal that markets are reassessing what they consider safe, real, and enduring. But the vulnerability of banks to a rapid rise in silver prices is closely tied to their extensive use of derivatives and large short positions, instruments designed to manage risk but capable of magnifying it under pressure. Derivatives allow institutions to control vast amounts of silver exposure with relatively small amounts of capital, creating efficiency in calm markets. Yet this efficiency comes with a hidden cost. When prices move sharply against these positions, losses can escalate at a speed that surprises even experienced risk managers. The hook is clear and unsettling. The tools built to control risk can become the source of it. Financial markets are built on perception as much as performance. Stocks, bonds, and currencies rely heavily on belief in future stability and institutional control. When silver rises sharply, it suggests that a growing segment of investors is questioning those beliefs. This does not imply immediate collapse, but it does indicate stress. Confidence, once shaken, rarely returns quickly. The movement of silver thus becomes a barometer for trust itself. Banks and policymakers watch this signal closely because it challenges the narrative of stability. A strong silver market implies skepticism toward inflation management, debt sustainability, and monetary discipline. It raises uncomfortable questions about whether current systems are rewarding real value or merely circulating risk. The hook is unavoidable. Silver does not argue with policy, it responds to it. As more capital flows toward tangible assets, the message grows louder. A rising silver price is not just a reflection of demand, it is a response to doubt. In that response lies a clear signal that markets are reassessing what they consider safe, real, and enduring. But the vulnerability of banks to a rapid rise in silver prices is closely tied to their extensive use of derivatives and large short positions, instruments designed to manage risk but capable of magnifying it under pressure. Derivatives allow institutions to control vast amounts of silver exposure with relatively small amounts of capital, creating efficiency in calm markets. Yet this efficiency comes with a hidden cost. When prices move sharply against these positions, losses can escalate at a speed that surprises even experienced risk managers. The hook is clear and unsettling. The tools built to control risk can become the source of it. Short positions, in particular, play a central role in this exposure. By betting on stable or declining silver prices, banks collect steady returns as long as the market behaves as expected. However, if prices rise rapidly, these positions require immediate action, either through additional capital, costly hedging, or forced liquidation. Each option carries consequences. Margin calls can drain liquidity, hedges can amplify demand, and liquidation can push prices even higher. What begins as a defensive maneuver can quickly become fuel to members for market stress. The complexity of derivative structures adds another layer of concern. Many contracts are interconnected across institutions, meaning losses do not remain isolated. One bank's attempt to reduce exposure can impact another's balance sheet, creating a chain reaction. This interconnectedness is often invisible during periods of stability, but it becomes painfully obvious during volatility. The hook lies in this fragility. When everyone is connected, no one fails alone. Another critical factor is the imbalance between paper contracts and physical silver. Derivatives often reference silver that does not exist in deliverable form, relying instead on settlement in cash. This system functions smoothly as long as market participants accept paper resolution. But in a rising price environment, especially one driven by fear or scarcity, demand for physical delivery can increase. When that happens, derivative exposure shifts from abstract risk to tangible stress. Promises are tested, and not all can be honored. Banks are well aware of these dynamics, which is why sudden upward pressure on silver prices generates internal concern. Stress tests and models are built on assumptions, and extreme price movements expose the limits of those assumptions. The real hook is not the existence of derivatives, but the scale at which they are used. When leverage meets volatility, control can disappear faster than confidence. This exposure underscores a broader lesson about modern finance. Complexity does not eliminate risk, it redistributes it. In the case of silver, derivatives and short positions concentrate vulnerability in moments when markets demand clarity. Not complexity, but investor behavior is undergoing a noticeable shift as confidence in traditional financial instruments weakens and uncertainty becomes a defining feature of the economic landscape. More investors are turning toward hard assets like silver, not as a speculative gamble, but as a strategic response to inflation, rising debt levels, and persistent market instability. This change is quiet, deliberate, and deeply revealing. The hook is simple yet powerful. When investors stop chasing returns and start protecting value, the market is sending a message. Inflation has played a central role in this transition. As purchasing power erodes, cash and fixed income assets lose their sense of security. Investors begin to question whether nominal gains truly represent real growth. Silver, by contrast, is viewed as a store of value that exists outside the reach of monetary expansion. It cannot be created by policy decisions or balance sheet adjustments. This physical limitation makes it attractive in an environment where financial assets feel increasingly abstract and exposed. Another key driver of this behavioral shift is the expanding global debt burden. Governments, corporations, and households alike are operating under unprecedented levels of leverage. While debt can fuel growth, it also amplifies vulnerability. Investors are becoming more aware that highly leveraged systems depend on stable conditions that may not persist. Silver offers a form of insurance against that fragility. The hook here lies in perception. Debt promises future stability, while silver reflects present reality. Uncertainty in financial markets has further accelerated this movement. Geopolitical tensions, supply chain disruptions, and unpredictable policy responses have made forecasting increasingly difficult. In such an environment, complex financial products lose their appeal, simplicity regains value. Silver is easily understood, widely recognized, and historically trusted. Its appeal grows not because it is modern, but because it is familiar. This shift in investor behavior also has a psychological dimension. When markets are calm, risk-taking is rewarded. When volatility rises, caution becomes rational. Investors who once relied heavily on equities or derivatives begin to rebalance, seeking diversification that includes tangible assets. Each decision, taken individually, may seem minor. Collectively, they create meaningful pressure on silver demand and pricing. What makes this trend especially significant is its persistence. This is not a short-term reaction to a single event, but a gradual reassessment of what constitutes safety as more investors prioritize resilience over returns. Silver's role evolves from alternative asset to essential hedge. That evolution reflects a broader change in mindset, one that values durability over optimism. So, a sudden shock in silver prices has the potential to ripple far beyond the precious metals market, influencing credit conditions, liquidity, and overall financial stability. Markets are deeply interconnected, and when stress emerges in one area, it rarely remains contained. A sharp move in silver would test not only individual institutions, but also the mechanisms that keep capital flowing smoothly. The hook is immediate and sobering. When liquidity tightens, confidence follows. Credit markets are particularly sensitive to such disruptions. Banks facing losses or increased margin requirements may respond by tightening lending standards or reducing exposure across multiple asset classes. This defensive behavior can restrict access to credit for businesses and consumers alike, slowing economic activity. What begins as a commodity price movement can quickly evolve into a broader financial constraint. The signal is subtle but critical. Risk aversion spreads faster than optimism. Liquidity, the lifeblood of financial markets, can also come under pressure. As institutions move to cover losses or meet collateral demands, they may be forced to sell assets rapidly. These sales can depress prices in unrelated markets, amplifying volatility, and liquidity that once seemed abundant can evaporate in moments of stress. The hook here is structural. Liquidity is most visible at the moment it disappears. The interconnected nature of modern finance intensifies these effects. Banks, hedge funds, and institutional investors are linked through funding arrangements, derivatives, and shared exposures. A shock in silver prices could trigger margin calls that cascade across institutions, creating feedback loops that strain the system. Even firms with limited direct exposure may feel the impact through tightening funding conditions or declining asset values. Stability in such an environment becomes a collective challenge. These dynamics often prompt calls for stronger risk management and regulatory oversight. Market participants and policymakers alike recognize that concentrated exposure and excessive leverage can transform isolated events into systemic concerns. A silver price shock would serve as a reminder that risk is not eliminated by complexity, it is redistributed. The hook lies in accountability. Systems are only as strong as their weakest assumptions. Beyond the technical aspects, there is a psychological dimension that cannot be ignored. Financial stability depends heavily on trust. Trust in institutions, in markets, and in the rules that govern them. When a single market movement threatens to disrupt that trust, confidence can erode quickly. Investors and institutions begin to question not just prices, but processes. In this context, a surge in silver prices is not merely a market event, it is a stress test for the broader financial system, revealing how prepared or unprepared it is to absorb sudden change. So remember this, whether silver hits $100 or not, the real lesson is already here. Systems change, markets evolve, and opportunity belongs to those who are ready. Do not fear headlines. Understand them. Do not panic with the crowd. Prepare with purpose, because in every moment of financial pressure, there is also a moment of personal power. Stand informed, stand confident, and most importantly, stand ready for the future.